1974, 1980, 2008, and 2024 all have one thing in common. The average person is extremely pessimistic about the future of the economy. In 1974, a massive oil shock paralyzed the global economy. In 1980, interest rates hit 15% and unemployment surged to 10%, the highest levels since the Great Depression at the time. And in 2008, we all know what happened. A massive housing crash and a crumbling financial system led to one of the deepest downturns in history. All three of these episodes occurred during economic recessions with rising unemployment. Today, unemployment is at one of the lowest levels in history. Inflation is much lower than it was just a year ago, and the stock market is making new all-time highs. When we look at stock market valuations, they're surging to some of the highest levels in history, meaning that Wall Street actually has a very optimistic outlook on corporate America. When we compare that to the average person's outlook on the future of the economy, we see this incredible divergence between Wall Street's expectations and what the average person expects from the future. We're going to dive into history to understand who is right about the future, because many people feel that financial markets today are not reflecting what is actually happening in the underlying economy, and that this is only going to end in one way. And on the other side, many people believe that these moments where most people are pessimistic are actually the best moments to be optimistic about the future of the economy, because you have to buy when others are fearful. That was the case, for example, in March of 2009, when people thought we were heading into a Great Depression, and that marked the beginning of a massive move up in the stock market. The difference today, of course, is that the market's valuation is actually at levels that are typically associated with a very optimistic sentiment amongst people. We were at similar market valuations during the 1960s, when the United States economy was thriving, and also in the late 1990s when people were feeling incredibly optimistic about the future. Now, the last time we actually saw such a difference between what Wall Street expects and what the average person expects is in 1983. The expectations of the consumer skyrocketed here as people became extremely optimistic about the future, and yet the stock market was still at one of its cheapest levels in history. We then saw the stock market actually catch up to the average person's sentiment over the course of the next decade. PE ratios went from around 7 back in 1983 all the way up to 20 by 1987. So this is actually the argument to say that the consumer is ultimately right about the real state of the economy, and that we should actually expect Wall Street's expectations to catch down to the consumer's expectations. And just like in 1983, where Wall Street hadn't adapted to the new reality of the economy, we're in that same environment today where Wall Street hasn't adapted to what is actually happening in the underlying economy, but they're gradually going to come to that realization. And that would make sense. If people feel very pessimistic about the future of the economy, they're not likely to make very big purchases, big investments, and so the economy is likely to struggle. Okay, great. Thanks for the doom and gloom, Peter. But consumer sentiment isn't going to stay depressed forever, right? Could people start to get more optimistic about the future here? One of the key things that is driving this pessimism today is that people are very concerned about the state of the housing market. Buying conditions for housing is at one of the lowest levels of the last 60 years. This is from a survey that basically asks people what they think about the housing market, and that's a direct result of the price of homes having risen significantly over the last few years, and also the fact that mortgage rates have risen significantly as well. The combination of these factors generally makes housing a lot less affordable today than it was just 3 years ago, and considering that most people have the majority of their wealth stored in real estate, if people don't have a good feeling about the housing market, then they don't have a good feeling about the economy in general. And today we are at a much lower level than right before the housing market crashed in 2007, and we're at similar levels to 1974 and 1980, all moments when consumer sentiment was very low. Now, of course, in all of these episodes, consumer sentiment eventually did recover, but that didn't happen by magic. In each of these cases, the Federal Reserve cut interest rates, and they did so quite violently. In fact, we can clearly see that every time the Federal Reserve interest rate peaks, it leads to a bottom in these housing conditions. That happens because when the Federal Reserve lowers its interest rate, it directly leads to lower mortgage rate, and so it makes homes more affordable. And And today, the Federal Reserve is expecting that they'll be cutting interest rates throughout 2024, and many people believe that these interest rate cuts will be enough to restart people's confidence in the housing market and so the future of the economy. And so this is how we could potentially see the best case scenario play out. The Federal Reserve cuts interest rates, and that boosts the housing market, which in turn boosts consumer sentiment and catches back up to what the stock market's valuation is reflecting today. Unfortunately, we rarely see this type of recovery in consumer sentiment without a recession occurring. You can see all of the big recoveries we've witnessed in consumer sentiment typically happen right after a recession occurs. And there's two reasons for that. Recessions often put downwards pressure on home prices, and so during an economic downturn, housing becomes more affordable. And secondly, the Federal Reserve usually cuts interest rates aggressively during recessions, and so mortgage rates drop, which makes housing immediately more affordable. Now, unfortunately, if we do get a recession, the chances are that the stock market is going to be declining during that period because that's what typically happens during recessions. Of course, in some cases, the drawdown is very small, but as a general rule, recessions are bad for the stock market. Now, many people believe that we are in a recession today, and it's just that the NBER, the association that labels recessions, has chosen not to label one today. And that's not completely absurd because one of the key metrics that they use to determine recessions is industrial production. And industrial production has actually been declining recently. When this line here is below the zero line, it means it's contracting relative to last year. And when that happens, it almost always coincides with recessions. The only time when it didn't coincide with a recession was in 2015 and today. So maybe we are in a pseudo recession where the Federal Reserve can cut interest rates, which can boost the housing market and so consumer sentiment, and never actually do any damage to the stock market. And in that scenario, Wall Street would actually be right because it would be the perfect scenario for the stock market to keep on rising. This is the soft landing scenario. Now, we don't think that's exactly how things are going to play out today. We're seeing the number of states in the United States that have a rising unemployment rate rise to 30%. Typically, when 30% of states have a rising unemployment rate, that's when a recession is starting to get very close. Of course, there have been periods like 1984 where we saw a small rise on this chart and no recession happened. These are soft landings, but it would be the first time in history where we don't see a recession get labeled by the NBER with 30% of states seeing rising unemployment.